Welcome back, traders. In this video, we will be going through the basics of Forex trading in just 10 minutes, breaking it down for easy understanding, so stick with me if trading the Forex is all what you want. We will be going through the content. Disclaimer: what Forex is. Participants, charts and quotes. Bull or bear. Forex market hours. Bid and ask prices. Spread, pips, lots and leverages. Taking profit and stopping losses, and then the last Forex analysis. Disclaimer: any information or advice contained in this video is general in nature only and does not constitute personal or investment advice. What is Forex? Forex stands for foreign exchange. It is the conversion of one currency into another currency. It is also a global market where currencies are traded. Participants. Who plays on the Forex market? Governments, central banks, normal bank, other financial institution, multinational companies, retail trader. You might be wondering, how can retail trader get access to the market? That's where the broker comes into play. Retail's trader goes to a broker who aggregate all the transaction and send them to the bank, which has direct access to the FX market. The chart. The very basic representation of the market at any point in time is a simple bar, and a bar is not more than prices being mapped in a graphical way. A bar always includes what we call OHLC, which stands for open, high, low and close price. We have the bar chart, candlestick and line chart. The three most common chat we all traders talks about. Number 1. Bar chart. Shows the open, high, low and close. This is not commonly used by trader. Number 2. Candlestick chart. Shows the same as the bar chart but represented differently. The candlestick is the most commonly used chart. Each of these candles has a body and two shadows or wicks. The top and bottom of the shadows are the high and low prices, while the top and bottom of the body represent the open and close prices of the period. And number 3. Line chart. It is the union between the close price and the periods in the chart. Here are examples of the chart, as seen in the diagram. The next is quotes. In a Euro-USD chart, the base currency is the euro, and the quoted currency is the USD. This price means that for every euro you would get 1.12000 US dollars. Conversely, to buy 1 euro you need 1.12000 US dollars. This chart simply expresses the value of the base currency on the left, quoted in terms of the quoted currency on the right. There are over 10 currencies in the world, and you can combine them in different ways to give you a currency pair. Most traders identify two groups of currency pairs, major and crosses. To show how serious you are, list down the major and crosses pairs in your jotters. Bullish or bearish. The bull and bear are the two animals that dominate the Forex market. A bullish market is said to be the raising of price over a particular currency pair, while the bearish is the falling of price over a particular currency pair, as shown in the diagram below. The next is the Forex market hours. There are 4 main Forex sessions. First we have the Sydney session, the Tokyo session, the London session, and finally, the New York session. Next we will be discussing on the bid and ask price. First of all, let's get clear with prices, bid and ask. If you want to buy a currency pair, you will be quoted at the ask price, which is always higher or lower than the bid price. This is the price that you will be quoted in case you want to sell the currency pair. Let's clarify this with the following example with the pair GBP AUD, that is the British pounds and the Australian dollars. If you want to buy GBP, you will be using the ask price, and you have to pay 1.8873 AUD. However, if you want to sell GBP, you will get 1.8866 AUD in exchange at the bid price. But what is that space between the ask and the bid? You will ask. It is called the spread. That is the cost of doing the business in the FX market. Let's talk about the spread. Pips, lots and leverages. Spread. Spread is simply defined as what you pay for carrying out a transaction. For the example above, Let's take a look at how can we calculate the spread. Spread is equal to the ask price minus the bid price. That is to say on 8,873 ask price minus 1.8866 the bid prices, which is equal to 0.0007 pips. The pips. Let's consider the first four-digit quotation system. 1.8866. Any currency pair that has four digits after the decimal point, except for Japanese-based currency pairs. The last digit is called a pip, that is to say if the price moves from 18,866 to 1.8867 a pip has been added, and if it is 1.8876 from 1.8866 10 pips has been added, and if it is on 8,966 from 1.8866 100 pips has been added. The number after the decimal changes when 1,000 pips has been added to 1.9866. You might reverse this video back so you understand what pips is all about. Plots and leverages will be discussed in my next video to elaborate more, so make sure you like and subscribe so you will be able to see when the next video will be posted. Next we will discuss about the take profit and stop loss. A take profit is an additional order which you can aggregate to your initial order, specifying that if the price reaches a certain level, then you want your buy order to be automatically closed so you can secure a profit. If the price passes the take profit level, your order will therefore be closed automatically, as showed in the diagram below. While stop loss is similar to the take profit, the stop loss is also an embed order that you can attach to your buy or sell order with the goal of limiting the losses in case the price goes in the opposite direction. If the price passes the stop loss level, the order should automatically be closed, as showed below. The last and not the least is the Forex analysis. There are three types of Forex analysis. Number 1, fundamental analysis. This type of analysis is based on the belief that somewhere in the world, there is information or knowledge that is not yet reflected in the market price. Fundamental analysis includes reading and understanding news surrounding certain currencies, understanding the global economic climate and what's happening in the world to affect the performance of a particular currency. It also involves understanding the current situation of resources such as oil, because certain currencies correlate with the prices and supply/demand of resources. A convenient way of doing this kind of analysis is through an economic calendar, which summarizes what is happening in the world. Number 2. Sentimental analysis. Personally, I think sentiment analysis is valuable but not substantial enough to be a standalone type of Forex analysis with which you can make reliable decisions. Sentiment analysis is more of an auxiliary which you can add to your analysis to make it more robust. Number 3. Technical analysis. This type of analysis is based purely on the belief that all available information in the world is already contained in the price. Therefore, all you need to do is analyze the charts with no need to analyze news or interest rates of the countries. Traders who believe in technical analysis think that prices move in trends and that historical patterns tend to repeat. This is how they proceed to take advantage of the market by opening a position. Thanks for watching. Please kindly like and subscribe to this channel if what you learned is of help, because more content like this will be coming. Goodbye for now and see you in my next video.